Assalamu alaikum wa rahmatullahi wa barakatuh. In this part, the second part of this topic, materiality and risk, we will discuss the second step of applying materiality in the audit process onwards. So we will discuss it in detail. So in this part, we will discuss and cover learning objective 3 related to the second step about the allocation of preliminary materiality to the segment of audit during the planning. So in step 2, we will allocate the preliminary judgment to the account balances or the class of transactions, which means the segment. So this steps is very necessary because when we collect the evidence, when we accumulate the evidence, we will collect it based on segment rather than the financial statement as whole. So we need to break down the materiality or the preliminary judgment in order for us to know the to measure the evidence that we collect, whether it is materially misstated or not. So we need to break it down. So this step is very important. The purpose on it, it is about planning, because step 1 and 2 is still in the planning stage. Once we allocate, it is referred, we didn't call it preliminary judgment. Once we allocate the amount into the balances or classes of transactions, we refer it to tolerable misstatement. Based on the ISA 530. So we will call it tolerable misstatement. In some textbook, they will call it performance materiality, but we will use the tolerable misstatement in this textbook. So the smaller the amount of materiality allocated, the more evidence to be collected. Okay, so let's see the example, our example here. To illustrate more about the step 2, if we can recall the example we discussed earlier, that we have total assets of 10 million and preliminary judgment has been set up in 5% of the total assets. So to calculate the total asset, the preliminary judgment for the total assets is 500, and then by considering the client history and riskiness, which is qualitative aspect, we reduce the preliminary judgment to 400,000, and then we allocate this 400,000 preliminary judgment, which is being set up as in the financial statement as whole. We allocate it into the sub account of the total assets, which is 10% to be allocated to PPE and 2% to be allocated to the inventory, as an example. So the tolerable misstatement for PPE will be 40,000 ringgit and the inventory to be 8,000 ringgit. So that is the simple explanation for the tolerable misstatement allocation in step 2. We break down the preliminary judgment into the sub accounts, preliminary or tolerable misstatement. 3 factors should be considered in setting up or allocating the materiality in to the account balances or in setting up the tolerable misstatement. The first one is the magnitude of the account relative to the financial statement. So the larger the account balance, the greater the amount of materiality can be allocated. The expectation of errors. So the more expectation, then we should consider less materiality or less tolerable misstatement on that account. The relative to the cost or to the audit. So some accounts, when we do audit, it's very expensive compared to other accounts. For example, the inventory. Large inventory means large cost of auditing. Okay, so we need to consider those three factors when we are allocating the materiality performance, or when we are allocating the tolerable misstatement. The third step is about estimating or determining the misstatement into each account or segment. So before we go on, we need to identify or differentiate between the two types of the misstatements. One is called known misstatements, and the second one is likely misstatements. Known misstatements means that the auditor is able to identify and determine the amount of misstatement in the account. Example, like if there is a misstatement of capitalizing some expenses, which is the auditor found it should be identified and recorded as expenses, but the management put it as capitalizing that expenses. So the auditor often will check the cash account. He is easily and direct. He can identify through the cash account. Okay, so for likely misstatement, we have two types. Uh, the first one is different between the management and the auditor judgment about the estimated account balances. So, for example, the depreciation estimation, maybe the management is having a different view, the auditor have different view, so they need to the auditor will decide whether it is acceptable, the view of the management or not. The second type of likely misstatement is projection of the misstatement. Projection of the misstatement based on the auditor test of the sample from the population. So whether this test on sampling is acceptable is acceptable to be projected into the whole population of the transactions of the company. So after the step 1 and step 2, which is in the planning stage, in step 1 we determine and set up the preliminary judgment in the financial statement level, and step 2 we allocate that preliminary judgment into tolerable misstatement in the account balances and account segments. So step 3 onward is all about the evaluating of the result. So we need to, after we evaluate, we need to determine the misstatement on the sample that we collect. So we need to compare what we found or the identified misstatement with in each account. We compare it with the tolerable misstatement for that account. So let's compare what we have in the example that we have just now. So we have total tolerable misstatement 8,000 for the inventory and 40,000 for the PPA. So let's say the misstatement we found is 18,000 for the inventory, and PPA we have 35,000. So in this case, what we will do, we will compare, and we can see that in the tolerable misstatement found for the inventory is more than the tolerable misstatement has been set in the step 2, whereby the tolerable misstatement on for PPA is still higher than or greater than the misstatement found by 35. In step 4, we will combine all the misstatements that we found in the level of the account segment. So we will total up all of that misstatement from all accounts. So from our example, we have 18,000 and 35,000. This one is equal to 53,000 total material misstatement. Total tolerable misstatement. Okay, step 5 is about comparing the combined estimate with the judgment about materiality. So if we remember in step 4, what we do, we combine the misstatement from all accounts, and in step 5, we will compare this result with the preliminary judgment which being set in step 1. So in our example, if you remember, our example, we have the preliminary judgment being set in step 1. It is 48, and we compare it with the total tolerable misstatement, which is 53. So it is greater than the preliminary judgment. In this case, we will consider the financial statement, particularly the total assets, has material misstatement. Okay, we will have more discussion and more illustration in the next example. So for this example, we have the step number 1. We set up the preliminary judgment for the current assets, which is 50,000, and step 2 is to allocate the 50,000 into the sub account under the current assets, which is the cash, the account receivable, and the inventory, and the allocation being affected by the size of the size or the volume of this account compared to the total current assets, and as well it's about the riskiness of that or the possibility or the expectation of errors. Last one is about the cost of auditing for that particular account. So let's say we consider all of that factors, and then we allocate the for cash is 4,000, 20,000 for account receivable, and for inventory is 36,000. To estimate the total misstatement in each segment, which is the step number 3, we need first to find out or identify the net misstatement for the inventory sample that we collect, and then we need to divide it in the total inventory sampled, which is the total amount of the sample of transaction in inventory, and then we need to multiply it to the total record of population value of the inventory, which is 450,000. That will bring us to the amount of 31,500 direct projection estimated of misstatement. This one is the estimated misstatement of the inventory. So we need to do all of this process for other accounts in order to get the projection or the direct projection estimate of misstatement, which we later on in step 4 we will accumulate all of this direct projection estimate of misstatement, and then we compare it with the preliminary judgment. So as we see here, we already get the direct projection for the inventory, and as well for the account receivable if we have the details for that. And then for cash we will not have direct projection. Reason, because in cash we will try to have total check or total test for all what we have. We will not have sampling for it, so we will not have direct projection or sampling errors. So we will directly have the tolerable misstatement based on the total population with there is no sampling for the cash. Whereby for account receivable and inventory we will have the same. This one, the preliminary judgment based on the financial statement, and the tolerable misstatement, which is in step 2. Direct projection is the step 3 when we accumulate. Then step 4, by accumulating all of this tolerable misstatement for each one of it. Sampling errors, we estimate of sample errors is 50% based on the risk that we are expecting. Then we will we will divide the 12,000, the direct projection, by the 50%, we will have the 6,000. Then we will accumulate 6,000 plus 12,000 will. Okay, in step 4, as we mentioned earlier, we combine the total tolerable misstatement, which is we combine all of this amount to get this amount, which is the total tolerable misstatement, 60,300. And then in step 5, we will compare this amount, the 60,300, with the tolerable or with the preliminary judgment that we set up in step 1. So that is as simple as that. Is we need to follow the 5 steps for the applying the materiality threshold. First, we need to set up the preliminary judgment in the in the financial statement level. Then we allocate this preliminary judgment into tolerable misstatement based on the segment and the account balances. Then after that, we need to determine and identify the misstatement based on each account and segment, and then combine them, combine the total and get the total tolerable misstatement. Then finally compare the total tolerable misstatement with the preliminary judgment, and that's all steps from A to Z. In step 5, in comparing the estimated combined misstatement or the total tolerable misstatement, which is 60,300, with the preliminary judgment 50,000, we can see that the estimated combined misstatement is greater and exceed the preliminary judgment threshold, which drive us to the conclusion of that the financial statement are not acceptable and it is not free from material misstatement. The auditor, before coming to the final conclusion about judging the financial statements, they need to conduct or perform additional audit procedures to confirm their findings, or to reconsider the estimation, or require the adjustment from the estimated misstatement by the client. So after we complete the discussion of the 5 steps of applying the materiality in the stage of planning, the audit, and as well on the testing and evaluating the evidence stage, then we need to say how materiality may affect the auditor report in the following steps, which is the stage of completing the auditing process and issuing the audit report. So giving any misstatement or error that happen, auditor need to evaluate and consider whether these misstatements or errors are immaterial. When we say immaterial, means it's not affecting the overall picture of financial statement, or it is highly material, mean it's material misstatement that required adjustment. This will affect the appropriate audit report to be issued in the stage of issuing report. Any violation against the standards of the financial reporting, materiality of violation, influence the auditor report should be issued. Based on step 5, which comparing the preliminary judgment with total misstatement, there are two scenarios between whether the preliminary judgment exceeding the total misstatement and vice versa. So if the total misstatement is less than the preliminary judgment, then the auditor can conclude that the financial statement is fairly presented and it is free from material misstatement, and the type of audit report in this case will be unqualified opinion. Otherwise, if the total misstatement is exceeding or greater than the preliminary judgment, in this case, the auditor should request the client to adjust the financial statement, and if the client refuses, auditor could issue a modified opinion or qualified opinion. With this, we complete the second part for this chapter about materiality and the risk. The next or the third part we will discuss the risk type and the audit risk in details, and see you in the third part. Thank you.